So it's now time for our weekly roundtable, and tonight we're discussing the investment lessons contained in the annual Berkshire Hathaway letter to shareholders. Joining me for this discussion is Nishlen Govender. He's the portfolio manager at Citadel, and then in studio is Simon Brown. He's the founder of Just One Lap. And a good evening to you both. Maybe just to share, if you're a listener this evening and you don't know what we're talking about. And Berkshire Hathaway is obviously the investment vehicle utilized by Warren Buffett, and once a year he would write a letter with his business partner Charlie Munger to investors, and that letter is the one that we are talking about tonight. I'll be reading some extracts out of that, and then I'll be asking for comment from the two listeners this evening. Simon, let's start with you. Thank you for coming into studio this evening. Your initial impressions on the letter?
Oh, look, I'm a nerd. I love them. I know when they're coming, I wake up eagerly. Then I remember time zones, and I have to wait for later in the day until it actually finally drops on their website. And ditto with the AGM, which we can now stream via Yahoo, which will happen first Saturday in May. I enjoyed it. I, as always, learnt a couple of key points. Retained earnings, we can touch on that. How boards are put together, etc., etc. What I think was quite telling is that he ended up by saying he's going to be bringing in some of his, for want of a bad phrase, deputies at the AGM. In other words, him and Charlie Munger have got a collective age approaching 190, and this is kind of them finally, I suppose, kind of getting ready for the next set to come through.
Nishlen, let's pose the same question to you. Your initial impressions.
Yeah, hi to both of you and hi to your listeners. It was an interesting letter. A couple of nice nuggets that investors can take away. It's always refreshing and a little bit calming to read Warren's thoughts, because you stop and think about how investing is very much long term. He, of course, has a benefit of a very specific Berkshire structure, which I'm sure we'll get into. But nice and refreshing just to take a step back and think about investing for the long term, diversification, what Warren himself looks at in buying new companies. And as Simon mentioned, some of those nuggets around board structure and corporate governance in general.
Simon, I suppose the one thing that most people maybe discount when they look at Berkshire Hathaway is that they have permanent capital.
Yes.
And permanent capital really comes from the insurance business that provides them with the capital in order to lead their investment activities. But it also means that because their time frames are so long and because they have permanent capital, potentially the decisions that they can make as an investment business is different to people that are potentially benchmarking themselves and don't have the benefit of permanent capital.
No, absolutely. I mean, the first page of the letter is always their performance going back to, I think it was 64 when Buffett took over the business, and they've had some bleak periods, not many, but certainly there have been some periods of underperformance, and they've got no concern with that money then exiting. Whereas if you're a fund manager and you've got quarterly performance, and you put 2 or 3 weak quarters together, and your money starts to vanish, and that's always going to be in the back of your mind. So he's got that permanent capital, and that then also enables him two other things. The one point is that he can move into the unlisted space, so he can go and buy stuff which me, you, and the average listener out there simply can't buy. It's not available on a stock market, whether it be Joburg, London, New York, or Hong Kong. We can't buy it. He can go into that space and buy it, and then his permanent capital grows and grows, because Berkshire Hathaway doesn't pay dividends. It never has, and in fact he's talked a lot about why he doesn't pay dividends, which means that it's not just that float at the core of the insurance, and there's been some regulatory changes over the last 40 or 50 years which have sort of reduced that, but at the point it's so big now that doesn't bother them. But they've just got these businesses, Sears Candy, which is a small little, makes candy bars, but it pumps out cash for them, and every year he's got that cash, and the question is, well, this is mine forever. What do I do with it? Where do I deploy it? Now, does it go somewhere new? Does it go to the cash pile? Or does it go to a business over there which they own, which perhaps is in need of some money? So he sits at the helm as a capital allocator, much as Joffrey at Bidvest and some others in our market in recent years.
Nishlen, I mean, this begs the question, if one just applies this to the South African environment. South Africa has got, in many cases, or in some cases, shall I rather say, some really decent investment opportunities available, even if we apply the Berkshire Hathaway matrices, and one looked at some companies in South Africa. Despite buying those, you've probably lost money on those for the last 2 to 3 years. I see clients saying to fund managers, but why did you buy this? And why did we lose money on something like this? And why are we even invested? And do you even know what you're doing? Surely that's the beauty of having permanent capital, is that you can actually stay the course. And obviously, years to come, you'll probably make a lot of money out of some of these things. But that takes sometimes the nerve of steel, and also clients that are prepared to stay committed.
Yeah, that's exactly right. A lot of my fellow portfolio managers in South Africa would love permanent capital. You sit down with a blank piece of paper as a portfolio manager, and you put out what you think is going to be a good investment philosophy and process. And quite frankly, many of those tenets are the same for Warren as it is for us. You want to be value sensitive. You want to buy companies who are earning a return on capital that's greater than your cost of capital. You want to think of yourself as an owner in this business and holding them for a long time. And South Africa is the perfect example. We've got excellent businesses in the small, mid, and now the large cap space, businesses with 10, 20, 30, 40-year track records. And the state of SA over the last 4 or 5 years has caused a destruction in capital in various places, but these are still fantastic businesses. But without the ability to have an infinite time horizon, or at least a long time horizon, you can't fully take advantage of that, because you are at the beck and call of your investors at the end of the day, and rightly so. I mean, if you think of private equity investors, both here and offshore, even those which are supposed to invest for the longer term, generally have a tenure of about 5 to 7 years, because investors do want their capital back. Berkshire has the benefit of investing for 2, 3, 4, 5, 10, 20 years, depending on how long that investment takes to come to fruition. And quite frankly, typical portfolio managers just don't have that ability.
And that, if I can jump in, in a sense, correct. I mean, the portfolio managers don't have permanent capital, but me as an individual, Simon Brown, managing my portfolio, I do, and that's why I love the Warren Buffett letters and the AGMs, because I am afforded that opportunity to cut myself a bit of slack and say, that's a great share at a great price. Where will it be in a week, a month, a year, heck, 3 years, 5 years? Don't know. Happy to sit and hold. And it is a luxury which we have in the space, which the asset managers simply don't have. And I think far too often, as private client investors, we act more like portfolio managers. We should act more like permanent capital managers.
Yeah, very good points, Simon. Let's get a little bit into the nitty gritty of the actual letter. Simon, let's start with you. I love how they start off the letter by saying Berkshire earned 81.4 billion in 2019, according to generally accepted accounting principles, commonly called GAAP. The components of that figures include 24 billion of operating earnings, 3.7 billion of realized capital gains, and then 53.7 billion gain from an increase in the amount of unrealized or net unrealized capital gains that exists in the stocks we hold. And that means now accounting rules are forcing them to take the unrealized capital gain and to actually put that into the revenue line for the business.
Yeah, and this
is the problem, right? I love how they started, because they actually point you to the problem that they face.
And this year they had a good year from it, and that's basically, so they bought Apple, price went up, that profit must get booked, and in the olden days it wouldn't have, and now rules have changed. And I'm in agreement with accounting rules keeping up to date. Like Buffett, some of them I think are a little bit strange, and I think this is one of them. Certainly there are places where you could use the inverse to hide issue. You buy an asset and it depreciates in value. You bought Steinhoff instead of Apple or something. But it is to your point. It's the playing clear cards. He says this is what we made, but hang on a second. Actually, that number is frankly just not true, because it's going to be wildly swingy, and this is the number we need to focus on. Now, a lot of companies will do what they call their own version of normalized earnings, and I'm often deeply skeptical of it, because as soon as someone's pointing you to the number that actually matters, you've got to make sure that you trust that person and that they use the same metric. Buffett's been moaning on about this for years and years, and is trustable. Some of the companies who want you to look at their number constantly changing what it is and how they calculate it, and that then is a whole different game. But it's classic Buffett to say, you think we did great? we didn't quite do that great.
Yeah, had to love that, and that's right in front of the letter. That's not somewhere in a note somewhere below. Nishlen, let's go to you. I mean, the other point that they make there is that well-managed industrial companies do not, as a rule, distribute to the shareholders the whole of their earned profits. In good years, if not in all years, they retain a part of their profits and put them back into their businesses. Thus, there's an element of compound interest. And he obviously quotes Maynard Keynes here. Operating in favor of a sound industrial investment, we are in a world where dividend yield shouts to investors. Is that not true? I mean, if I have to listen to another international investor say to me, why don't you just buy a company with a high dividend yield? It almost takes away from the essence of why you're buying a company, which is really the fact that it can compound and that its return on invested capital could actually be quite high, and it's probably be better left to the company.
Yeah, I always struggle with certain investors who focus on something like a high dividend yield. From a value perspective, it can be a good screen to try and look for companies that have a high dividend yield, but quite frankly, a dividend yield is a dividend divided by price. And if something sits on a high dividend yield, it could very well be because the price absolutely fell through the floor. And if that is the case, and if that stock continues to face pressure, your high dividend yield will get higher, which might seem attractive, but remember, it means that your share price has fallen on a stock that you hold. So high dividend yield in and of itself is not the best metric to understand the company. But if you do have a dividend focus, by all means, look for high dividend yielding companies. But what Buffett is effectively saying, and it speaks to both his investment philosophy as well as Microsoft's, to be quite frank, Bill Gates and him are actually very good friends. The idea that if you reinvest in your own company, and if that company is earning a return higher than its cost of capital, you can compound returns through time. And in our day and age, when markets are as liquid as they are, you can earn a fantastic total return, which is dividends plus capital gain, by holding on to stocks. So or less and less focused on dividend yield. I mean, when I read that part in the letter, I was a little bit surprised reading it, because any first-year university student in finance, or even just a layman investor, would understand that and incorporate that already. So it's another nice nugget to bring us back down to earth, I think.
Simon, it's certainly not an issue here in South Africa. Fixed income continues to provide a decent yield here in South Africa, but certainly internationally, yields are incredibly low. The US 10-year has just fallen through 1%. I think that's telling in itself, and it's saying something to the market. But in the world where bond yields have been so low in Europe and the United States, it was easy for companies almost to dish up a high dividend yield, almost ramp up dividends in order to attract investors, in order to buy the actual shares. I looked at a medical manufacturing company the other day, which will remain nameless, but where the debt numbers just continue to escalate, but the actual dividend payouts continue to swell with it, and hence the dividend yield would then go up with it as well, so that they could support higher and higher stock prices. That's a futile game. I mean, you're not really serving the benefit of your actual business. You're trying to just keep shareholders on side and invested in your company.
Yeah, and you're 100% right, and you're attracting the shareholders by it's not an artificial metric, but it's not a true metric. You're dangling a dividend yield instead of dangling a quality business instead. I mean, I've always been a fan of dividends because it's how I get cash flow from my investments, and at this point in my life, I take that cash flow and I redeploy it back into the business. But Warren Buffett's never been a fan of dividends. He's always said, either you trust me to keep that money and build it, or you don't, in which case sell the shares. There's a tax implication. In South Africa, dividends taxed at 20% for me. My max CGT cost is 18%. So actually, Buffett has said in the past, if you need income from Berkshire Hathaway shares, well, sell a couple and take it that way and pay the CGT. But what he talks of, and it's a book I'd never heard of, Common Stocks as Long-Term Investments, Edgar Lawrence Smith, published in 1924. Available on Kindle. I love the future we live in. So I'm busy reading it. And he looked at, a company makes money and the board decides what to do with it, and maybe they, some of it goes to shareholders, maybe they juice that to make their investment look attractive, as you say, whilst they got debt lurking, but some of it they grow in the business, keep in the business. And truthfully, the more they keep in the business, assuming a good business, assuming a good, they're beating return on capital, that retained earnings becomes immensely powerful and compounds at staggering numbers. And, run that over, 5, 10, 20 years, and your retained earnings are significant. So it's had me, and I've known Buffett's aversion to dividends for a while, but that comment really has had me sort of rethinking my view about it. And not to the sense that I'm going to say don't give me dividends, but the cash flow is nice, but I don't need it, so really what's the point there? And if the company's well run, then keep it. Of course, if the company is not well run, why do you hold it anyway? So that kind of becomes moot in a sense.
But I think maybe, Nishlen, let's get you involved here as well. I suppose that's the big issue, is what makes and what qualifies and quantifies a good business. He talks about in the letter, reinvestment in productive operational assets will forever remain our top priority. I think they spent on property, plant and equipment a total of $121 billion US. Not enough time and effort is being spent on the understanding, I suppose, at the end of the day, of return on invested capital. What can a business do with its own capital, and is it better just to pay it out to you, in which one would then question the investment at the end of the day, or what are they doing with the capital in order to make it grow? Nishlen, this surely is important points, right?
Yeah, definitely. Warren Buffett talks a lot about return on invested capital. For us personally at Citadel, what we call ROIC over WACC, or return on invested capital over your cost of capital, is a crucial metric. It's important to note, though, with that in context, valuation is always crucial. So whenever Warren talks about ROIC versus WACC, he often talks about valuation and being valuation sensitive, and that is crucial because you can overpay for a business that is earning a very reasonable return on invested capital, and that is the hill that you're trying to avoid climbing. And they've been excellent through the years at buying, especially on the unlisted side, whether it be on the insurance or the non-insurance side, a collection of business at attractive valuations. And that has been crucial. And they have been high-quality businesses, especially from a return on invested capital perspective. But we mustn't also underestimate the management capability. Warren Buffett really does focus on humble, hardworking, honest managers, and he's got a collection of them now. Some of them are potentially going to take over from him and Charlie. Guys like Ajit Jain and Greg Abel and Todd and Ted, the new portfolio managers. They're just a fantastic group, and you look at the underlying companies too that they bought over the years, fantastic management teams. Put all of that together, and that's effectively what Warren Buffett and Charlie Munger are looking for, and it's worked well over the last 60 years or so.
Yeah. It's Simon, back to you. Tom Murphy, he says, a value director of Berkshire and an all-time great among business managers, long ago gave me some important advice about acquisitions. He said, to achieve a reputation as a good manager, just be sure to buy good businesses. How often does that really happen in the real world?
About a third of the time. Mergers and acquisitions, and this is an old stat that's been floating around for decades, and it's a global stat, so we don't have to look at Woolies and the like in South Africa. Mergers and acquisitions usually are poor for two simple reasons. One, you tend to overpay for them, and two, they never quite deliver those synergies which are promised. And Buffett goes on in the letter to talk. You can see how it plays out in the board. The CEO comes and he's got this great idea, and it's going to make vast amount of money, and bonuses are going to go through the roof, and the business is going to quadruple in size, and there's lots of rah-rah and confetti and etc. But it almost becomes a cult status rather than actually, well, hang on a second, why are we buying it? Why are we, paying a premium? One of the big things about, particularly when you're buying a business in the listed space, is you've got to pay a premium, 20, 30, 40. Steinhoff paid 100% premium when they bought Mattress Firm. The whole market just got that so wrong that Juster in his infinite wisdom was prepared to pay twice what the market did? The answer is no. And we see it time and time again. David Jones, Gourmet Burger Kitchen, and so that list goes on, where you've simply overpaid for the asset, and the numbers are just not going to work. They're never going to work. And what you need is you almost need to, there's the team of the M&A, the mergers and acquisition experts out there, and you'll come to and help you. You almost need the anti-team so that you can get both sides of the story. You've got the M&A lovers, and then you pay someone also top dollar to come and just poke holes left, right, and center in your proposed big deal.
So, Nishlen, maybe a good business manager doesn't make a good CEO at the end of the day. Knowing and understanding how to run your underlying business is important, but a CEO sometimes has to make tactical decisions about the capital inside the business. And the people that migrate themselves up from being a good business manager to CEO status, those people are sometimes not to say those people are sometimes the same people. Those are the people that get rewarded, but they don't necessarily make the best CEOs.
Yeah, unfortunately, that is the case. And often there is a lot of pressure on CEOs to do something. And that is a problem and a concern. And a typical CEO will have a bunch of investment bankers knocking on his door to enthuse him to do something, to change his balance sheet around and take on more debt because he can get the benefit, the tax benefit. Or he should do a merger and acquisition, or from a vertical perspective, buy companies in the supply chain, or go down the supply chain. And there's always that rumbling in the background that you could do more and maybe you should do this. And some of it's also empire building, where CEOs want to grow a small company to a massive multinational conglomerate, and you can understand why you might want to do that. There's this human endeavor of wanting to grow and do more and be more. But the best CEOs often understand their businesses really well, will do something within their businesses from necessity and not necessarily because they want to. And Warren actually says in his letter, not necessarily about CEOs, but about members of boards of directors. Some people just aren't good managers, and some people are just not good members of boards. They're good at other things, and quite frankly, we need to do that. And the board of directors just needs to focus on finding the best CEO for the extreme long term. And quite frankly, Berkshire Hathaway is an example of that. They've struggled for a long time on considering who could be the next CEO. And only in the last 2 years has Ajit and Greg Abel been made non-vice chairmen now. And we're only now seeing that succession planning. So they're taking it very seriously too.
Simon, the crux of that business or shall I rather say that the size of Berkshire Hathaway would never be what Berkshire Hathaway is if it wasn't for the insurance business, and if it wasn't them finding the insurance business when they found it. He makes the point, he says, the collect now and pay later model leaves property and casualty companies holding large sums. Those sums we call the float that will eventually go to others. Meanwhile, insurers get to invest this float for their own benefit. Our property and casualty insurance business has been the engine propelling Berkshire's growth since 1967. The insurance certainly, I think Warren and Berkshire found the insurance business almost at a point when it was almost undiscovered. They didn't understand the real mechanics, the financial mechanics that were actually at play inside those. Today they're well known, but natural disasters and the fact that we've got climate change. Could you imagine being a property and casualty business in Australia, for instance, having to now fork out for large amounts of what the fire caused there? Yes, surely you can go to your reinsurer and you could go and find yourself, a reinsurance claim. But that just puts the reinsurer under pressure. I wonder if insurance is going to carry on being the great business that it was in the 60s and 70s and 80s.
I think not. And to your point, I think when Buffett found it in the 60s, I don't think truthfully, he and Charlie Munger fully understood what they had found and the power of it. Because, to your point, it's collect now and pay later. So we all pay our premiums and they go and invest it. And, any profits and the like that they make off that it's theirs. And you go and buy clever, as Buffett and Munger did, and you get great profits. And that then builds the next flows, as you point, reinsurers, but of course they own some reinsurers at the same time. I was chatting to an insurer who is a large insurer in Australia, and they're anticipating they're going to lose some money this year. And I said to him, okay, so this year it's going to hurt. I said, but if this is a one in a decade or one in a century, but what happens if this starts becoming a every 3 or 4 years or every year or type of thing? And he said, then our business model is fundamentally broken, and then you pass that on ultimately to the clients. Now, there's been a squeeze. Conduit Capital, Sean Riskovitz kind of tried this with Constantia Insurance locally, but the new regulations are around, and some of them are Basel and the like, of that float and how you can utilize it, have made it a different game to, as you point out, what it was in the 60s, 70s, 80s and 90s. And then sort of natural disasters, climate change, that coming through. And maybe we're just in a purple spot spot, and there will be a more of a return to normality in a sense. But the fires in Australia, for example, are only over now. I mean, literally yesterday I read an article that said there are no longer any out of control fires in Queensland. It's been going on for months and months, and the costs are going to run into the billions.
I suppose the other thing, Nishlen, with the insurance companies that take into consideration is the cost of regulation, the regulatory frameworks, how you sell that insurance. I mean, the cost of running an insurance company today must be much higher than it was in the years gone past, just from a cost of writing new business. And then obviously competition has become fairly large as well. How you sell these products, etc., becomes quite important for you to be able to almost carve a niche for yourself. Is insurance really what it used to be in the 60s and 70s and 80s?
No, definitely not. I think if you had to start an insurance business today from scratch, the regulatory burden is significant. The amount of competition and the amount of entrenched competition is absolutely significant. Yes, there has been some disruption from innovative players, both here and offshore, but that is only starting, and the entrenched competitors are obviously taking that on board quite quickly. I think with Berkshire, they do have a business model that can endure, simply because of the size of those businesses, how long they've been operating, and how entrenched they are in the American market. So if we talk about Geico, the auto insurance company, Berkshire Reinsurance, etc., they've been around for a long time. They continue to get significantly good business. They're very, very good risk allocators in terms of the business that they do operate on. America is also an odd place in terms of how different it is. You've got earthquakes on the west, and you've got the weather issues around hurricanes, tornadoes in the middle, and then you've got sort of other weather-related issues with respect to storms and things on the west. You can actually diversify across the spectrum. And remember, it's also property casualty insurance. So a lot of that also is payments that do take place over a long term, and it is quite sticky usually. So I actually think Berkshire will continue to do well with insurance businesses, and I think the unlisted space in terms of non-insurance and insurance combined now is so significant, generating such significant cash flow that they should never have a float issue, even if there were large claims. So I think Berkshire, as it stands, actually is a reasonable investment vehicle from both the insurance perspective and what it allows from an investment side for the long term.
Simon, one of the things that might make you quite ill today is if one looks at their energy business. Now, this points specifically to the long-term investment cycle that they have, because their client base is in Iowa. Basically, they pay 8.8 cents per kilowatt hour. That's they've risen less than 1% a year over many years. Their nearest competitor charges a fee that is 61% higher than what their energy company pays. And the reason for this? Well, it's because years ago they started actually changing to more renewable energy sources rather than just relying on the old ones. One wonders if you, and I suppose the issue here is, yes, private capital making decisions about the future versus a case in South Africa where you almost have government money trying to make investment decisions. Much more difficult, right?
Well, much more difficult. The private capital has proved it can work. They can be the cheapest cost provider across like 13 of their immediate states and still make a profit. And what really struck me with that is that utility company, and usually you buy a utility company for dividends. That company's never paid a dividend. So Buffett has never made a cent of profit from it. It's just its asset size has increased because it takes those profits, takes those retained earnings, pitches them back into the business and grows it. And that growth is both in scope but also in the technology. 20 years ago, wind turbines were inefficient and expensive, and they've been at the forefront of improving efficiencies and driving those costs down. And Warren Buffett is happy to sit there holding an asset that has paid him nothing, and very clearly shown to the earlier point when we were talking about CEOs versus managers, around the ability to allocate capital. And politicians are good for something, and I'm scratching my head, but certainly they're good for, kissing babies at elections, but they seldom, truthfully, the right people to really be running the businesses that we find not just locally but globally, and of course, with some fairly disastrous consequences for South Africans and SA Inc.
Nishlen, let's get your opinion about that. You've literally 1 minute left of the show. This is a classic example where government has left the business to its own devices. They today collect, the US government collects $3.6 billion in tax from this business. Best for governments just to leave companies alone?
To a certain extent, yes. Utility is very different in America. It is heavily regulated, and that is the key. In South Africa, we kept hold of electric assets because we knew how important it was for our country to maintain. We could have done that, or we could have highly regulated them, which is what America did, and it is working fantastically well. You leave it up to the utility itself to manage itself, and Berkshire's just been very good at reinvesting, reducing costs for clients, and increasing their margins just because they get better at operating. It's a lesson that should be learned throughout the world and has been in different countries. I hope to a certain extent it comes to South Africa via IPPs, etc., and we can move forward.
Well, that was tonight's roundtable, and that's unfortunately the end of Classic Business this evening. Michael Avery will be back in the studio with you tomorrow evening. Thank you for joining me. My name is Kirby Lachrunji, and I'm a co-founder of Rexalam Invest. Up next is Richard Koch in Johannesburg for the Full Works, and Kenetsi in Cape Town for the Jazz Lounge. Good evening.